Welcome back. Let's take a look at futures this morning. We are looking at a lower opening for the broader averages. Dow Industrials right now down about 36. It's a big week for data. The NASDAQ is down 51. Check interest rates before we go through some of these expectations on inflation data. The 10-year Treasury yield right now sitting at 4.258% as the Fed kicks off its monetary policy meeting, the last one of the year. Tomorrow and Wednesday, we are expecting a pause. There's a top story in the Journal this morning, the title, when bond yields dropped, the everything rally kicked off. And that is exactly what has been happening. Gold, crypto, stocks all soaring as interest rates came down. The Wall Street Journal's Nick Timrose also writing that while the Fed Chair Jay Powell's fight to lower inflation is succeeding, many still have questions on when the central bank will start cutting interest rates. Joining me right now is Oxbow Advisors Managing Partner Ted Oakley. Ted, great to see you. Thanks very much for being here. We've been talking about this debate on the Fed, whether or not we're going to see more rate hikes or if the Fed is going to pivot and to start cutting interest rates sometime in 2024. What are your expectations?
Well, you know, Maria, I don't think with where inflation will be and where the unemployment sector is right now that they'll be quick to turn the rates down. I would be surprised at that. I think Wall Street thinks they are, but it doesn't look like this that they'll jump in automatically and start lowering rates.
Yeah, I agree with that. Liz Peek, jump in here.
I think one question for the Fed is the demand for treasuries. I mean, basically, we are creating an enormous amount of deficit spending, and that doesn't seem to have any possibility of changing. So is that going to influence rates and the Fed's efforts to bring down interest rates going forward? We're have to sell these bonds, in other words.
Well, it will eventually. I don't know if this is the year, but as we go forward, we're 33 trillion. We put on, I think, 2 trillion just this year. And, they've got a wide open spigot between now and the first part of 25. I suspect they'll use it. And somewhere along the way, Liz, you're right. There's somewhere you hit the wall and you do a crowding out situation. I don't know if it's in 24, but I do think it's coming sometime in the decade.
Well, I mean, the administration keeps trying to sell us what they call a great economy, Bidenomics, and yet inflation is still elevated. Of course, we've got all of that data coming out this week, Ted. November CPI out tomorrow, the PPI out on Wednesday, retail sales on Thursday. How would you assess the macro story right now?
Well, I think it's still the same, Maria. I think you're looking at still roughly 3.5% inflation over the first 2 or 3 quarters of next year, too, at least the first quarter. I don't think that's going to change the Fed's mind just automatically. I mean, if you look at what they're looking for, if they're trying to get their 2%, and they're not in a place where they would come in automatically lower rates. I think the same thing goes for employment. And really, if you look at, I have a hard time understanding the great economy because if you look at a lot of sectors of the economy, they're not all that great right now.
What do you mean?
Well, if you look at housing, we just hit a new low in sales. And if you look, people are having a hard time right now. If you look at the consumer from the standpoint, they're going in deeper debt. They're behind on the credit cards. A lot of things going on with the average person out there that really doesn't give you an idea that, hey, things are booming, happy days are here again. And sort of, it's not like that, we don't think.
Cheryl, jump in here.
I'm curious, Ted, you mentioned about the 2 to 3 quarters of inflation. I'm assuming you're meaning that headline number staying in the 3% range. Even the estimates for CPI for tomorrow, the core number, the year over year, that's still at 4%. And Charles Payne pointed this out Friday. I want to pick this up again. He said, look, we came down from 9.1% record high inflation in May of 2020. But now the fact that we're still sitting after all of these rate hikes, I think 11 moves we've had from the Fed, you still have these numbers sitting above 3%, and we're nowhere near that 2% target. What you're saying is we're not going to get anywhere close to this until the middle of 24?
Well, I'm just thinking that you've got another 4 to 6 months from here. I mean, I'm not, obviously just looking ahead. If you look at sort of what factors into that at this point, I just don't see us getting tremendously below that number. I suppose you could if you go into a steep recession right here, but it doesn't look like that to us right now, at least for the future quarter or so.
So how would you allocate capital, having said all of that, Ted? How do you want to be invested going into the new year?
You know, we're about the same, Maria, as we've done most of the year. We're in the markets. We're not fully in the market. We have a lot of liquidity that we're getting, 5.3, 5.4% on in the Treasury. We've added, a number of defensive type names during the year, and things have been okay. It's just that our allocation to equities is still reasonably low relative to where it's been the last 10 years. And we haven't really changed the bond look. I think people to be chasing the long bond right now need to really think about that, because it's going to be a tough decade, in our opinion, to be owning 20 and 30-year paper.
Yeah, great point. All right, Ted, good to see you. We so appreciate it. Look at this market year to date, 37% gain on the NASDAQ. We appreciate your time, Ted. We'll catch up soon. Thank you. Ted Oakley joining us.
Hello everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe and you'll see more of what we do here at Oxbow.